The difference between futures and options. I'm not saying one's better than the other in this video. I'm just breaking down the differences between the two. We're going to look at some setups and what it looks like if you're taking the trade on a futures versus taking the trade in an options trade. We're going to get into all of that in this video. So first things first, futures are very high leveraged. Okay, so for an example of that, I'll just break down one of my trades real quick. So for this trade, you see I traded 6 contracts. Okay, so in the futures world, your position size is based in contracts or lot size. In this example, I traded 6 lots, 6 contracts, and I made about $23.75 for this particular trade. Now, how much money did I need to put up? So with futures, this is a futures trade. With futures, you have to put up margin. Okay, so there's a certain balance you need to maintain in your account to be able to open up futures contracts. In this case, the broker I was using, I only need $500 in my account to open up 1 contract. Okay, so for me to open up 6 contracts, I would need $3,000 in my account. Right, that's your margin. Okay, every broker is going to be different. Like if you're trading on TD Ameritrade, they're not a specific futures broker, right? They offer you stocks, they offer you options. So their margin's a lot higher. For you to open up 1 contract on the S&P 500, which is what we're looking at right here, you would probably need around $10,000 in your account minimum, okay, just to open 1 contract. So if you find and there's brokers out there for futures specifically that let you trade if you're just day trading with a lot less of that margin requirement. So like I said, with the broker I'm using, I only need $500 to be able to trade 1 contract. So for this trade, I needed to have $3,000 in my account, and I was able to execute that trade. So futures are very highly leveraged, right? I could be able to trade a contract with only $500 in my account. And that could hurt you if you don't know what you're doing, right? If the market starts going against you, that 500 could be wiped away pretty quickly, okay? So I'm going to show you some examples of trades here in a second. That's just an example of how futures are very highly leveraged. Second thing, you don't need 25K, okay? So in the stock market world, if you have under 25K and you're using a margin account, you can only do 3 trades a week. All right, so that's not the case here in the futures. If you have under 25K, futures is a good option for you because you could do unlimited trades with under 25,000. All right, so for my example before, with that $3,000 in my account, I was able to open 6 lots and trade the S&P. I could have made 100 trades for that day, right? And it wouldn't matter. So you don't need 25K. There's no pattern day trader rule if you have an account, margin account open, and you're only trading futures. Okay. Third thing is you're trading based on pure price action. Okay, so there's no confusing Greeks or anything like that. You're just trading strictly price action, and if you think the market's going up, you're buying straight up, right? You're not worrying about the options or what strike price and the theta decay and all that stuff you have to deal with in the options world. With futures, it's just straight up. If I want to buy the thing, I'm going to buy it here. And yeah, that's how it works. Okay. And also, your profits and losses beforehand. This could get a little tricky with options because your contracts, like I said, there's so much that's involved in pricing an options contract where you don't really know the exact amount that you're going to lose on a trade if you have a stop loss, because those option contracts fluctuate so much, right? So with futures, your defined risk to reward, your defined stop loss, how much you're going to lose on a trade, how much you could potentially make. So I'll show you an example right here. This is a little feature where I could just go back and replay the market. So for this example, this is how futures work, okay? So right now you're seeing the S&P 500, okay? You're seeing the S&P 500, and right now it is trading at 4307.75. So if you look on the right, this is the active trader. This is where you actively place your trades on this platform. All the platforms are pretty similar, right? They all look the same. But if I wanted to buy the market right now, right? I would click buy one, and you'll see how the price fluctuations go, okay? So it's not like you're trading a stock like Apple. For example, Apple, the stock, let's say it's $100, it could move up to $100.01, $100 2 cents, $100 3 cents, right? It moves in penny increments. Whereas with futures, the S&P 500 specifically, you can see on the right over here, it moves up in quarters, all right? These are called ticks. So for every tick the market moves in your favor, that's worth $12.50 per contract, okay? So every 4 ticks is called a point. So if the S&P moves up $1, let's say, that's worth $50, okay? That's a point move. So for every dollar, it's called a point. So like I said, I just got long. This means I want the price to go up. And if it goes up 1 point, I'll make $50. You see my P&L on the right over there? That's how it works with futures, okay? So let's say, I'm wrong if this trade gets under this swing low right here, 4,300. We'll call it 4,300 even. All right, so I could just scroll down here and put my stop loss at 4,300 even. So now I have a stop loss in place. If price was to go down to 4,300, I would get out and I would lose $387.50. Okay, so I know my defined losses, right? I know my defined loss. If price gets under here, this trade doesn't work out, I know how much I'm going to lose on this setup, and it's $387.50. Whereas with options, it's like if I buy a SPY call right here, and it pulls back that far, depending on what option you get, it could be down 20%, it could be down 50%. If you're trading the 0 days, it could be down even more. So with futures, you have a more consistent edge as far as knowing exactly what you're going to lose on a trade. And yeah, so that's another difference between futures and options. So let's just play this out and see what the market does. As long as it goes up above 4307.75, I'll start to make money on this trade. And you can see the fluctuations for every point that it goes in my favor. For every dollar the S&P 500 futures contract goes up, I will make $50. Okay, so in this case, it's already jumping up to 4309.75. Kind of just fluctuates. So the fluctuations are all in 25-cent moves. They're called ticks. So let's say I set a target up here, 43.27, right? That looks like the overnight high from the previous overnight session. So let's go ahead and set up a sell limit at 43.27. So again, I'm going to be able to calculate my gains. I'll put it up 20 points. Okay, so for 20-point move on the S&P 500, even though this market is just kind of sideways and choppy, no real direction, I'm still going to be able to make $1,000 on this trade. So that's pretty good. The market's really not in a clear direction. You can see we're still inside this choppy range from the overnight session, but we're able to play this balance, buy near the lows, and if we get that reversion back up, if we get a rotation back to the upside towards that overnight high, we have our target at 43.27, and if it gets up there, we'll make $1,000. Okay, so that's a 20-point move, and like I said, with the futures contracts, every point is $50. In this case, we're trading one contract. 20 points is going to be worth $1,000. Okay, so for the options, I don't really know where my contract is going to be when the S&P gets up to 43.27. In this case, on the futures, I know exactly how much I'm going to make on that trade. So it's a lot more consistent than options, right? So I just skipped ahead to see what the hell this market would do. Like I said, there's a replay. So this is all simulated back from Thursday and September 28th, it looks like. And look, right now the price jumped to 43.1850. I'm up $500 right now and counting. As more of this goes up, the more money I'll make. Okay. So what do we got next? Like I said, you know your profits and losses beforehand. With futures, with options, kind of tricky. Whenever I take a trade on options, I'm not really sure how much I'm going to lose if I get a pullback in the market. You have a ballpark, but you don't really know the exact amount. And futures are very liquid. The ES and the NQ, which is the S&P 500 and the NASDAQ, they're the most liquid markets in the world. So you won't have an issue getting in and out of trades with no slippage. And yeah, they're the most liquid markets in the world. And there's also, most people don't know this, there's better tax advantages with futures, right? Futures are taxed at 60% long-term and 40% short-term capital gains. Okay, so if you're making a lot of money trading futures rather than options, at the end of the year you're going to get a nice savings, right? If you're making a substantial amount of money, this tax advantage is going to add up for you. All right, hold on real quick. I almost forgot to add something. There's another important thing about futures. They're actually open overnight. Okay, so futures are open 23 hours a day. It's not like the regular stock market where the market's only open from 9:30 in the morning up until 4 p.m. Eastern time. Well, the futures, they're a global market, so they're open up overnight. So they're open 23 hours a day. So if you see the market right now it's about, what time is it? 9 o'clock at night. The market's open and I could trade. So this is good for the people who aren't able to trade during the regular stock market hours from 9:30 to 4, or simply if you don't want to trade from 9:30 to 4 and you just want to trade the overnight session. So all these shaded areas you see, these are the overnight sessions. And look, they offer very good moves on a daily basis. So sometimes when I wake up in the morning and I'm looking to trade the 9:30 open, well, the market's already made quite a move sometimes. So in this case, the market was at a low from 43.27 and it ran up all the way to 43.70, which is, let's just call it even a 50-point move higher. So you could catch good moves during the overnight session. There's people I know who only trade the overnight session. Some of my international friends who aren't awake at 9:30 Eastern time to trade the New York session open, well, they're trading the overnight session, right? So it's up to you. You could decide if you want to trade the regular market hours, the regular stock market hours, or if you want to trade just the overnight session. So this is something that's not available with options trading, only with futures. So what's cheaper, futures or options? So let's say, we took that same exact trade on the futures at 43.07, which I just showed you. Like I said, we need $500 in our account to execute that trade. If we don't have $500 in our account, we're not going to be able to open that position. All right. So 500 is the minimum that you need to keep in your account for most futures brokers out there. And yeah, that's how much you're going to need in your account for that. And our stop loss is 43.04, like I said, or in this case, our stop loss was 4,300 before, but for this example right here, let's say 43.04 is our stop loss. Okay. Right below, or, kind of close to that low of the day. That's 3 points, right? 43.07 long, stop loss 43.04. That's 3 points. That's $150 is our max loss. And our target, let's say it's 43.23, right? 43.23 for this example. That's 15 points from our entry. And that's about $750 worth of profit. Okay. So if we did this with options, all right, let's say we bought 2 call contracts. Whenever I'm trading options, by the way, I'm doing my analysis on the S&P 500, the futures contract, and I'll take like a SPY call or a SPY put if I think the market's going down, right? So I'll do my analysis on the S&P, and depending if I think there's a large move or not, I'll take an options trade, probably on SPY or SPX, right? Most of the time SPY. So in this case, you buy the same move, same exact move where we're entering the S&P 500 futures trade is on the right. Let's say we bought options instead, okay? So we bought options instead, and at that same time of our entry, these options were about $2. So if we buy 2 contracts, that's going to cost us $400. And let's say we take profits at 43.23, which is where we took profits on the futures. You see this market bounced up a little bit, took profits at 43.23 and made our 15 points on the futures, which was $750. And in this case, the option contract, which you see here on the left, we bought it at $2. Now it went up to $2.65. Well, that's about a 65-cent gain per contract, which equals 130 profit on a almost $500 investment. Okay, so that's a 26% gain, which is not bad. I'm not saying don't trade options. I'm just breaking down the two. Okay, on the same move with $500 in my futures account, I was able to capitalize and make $750, where really I was only risking $150, because if you go back here, my stop loss, I had a set stop loss. If the price came down, I was only going to lose $150. Okay, so I had 500 in my account. I was only risking 150. In this case, on the option, right? I put up $400 at the $2, and I made 65 cents gain per contract on the options, which is $130 profit on a $400 investment. 26% gain, not too bad. But yeah, you could just see between the two, I think the more favorable trade was definitely on the future side in this example. There's no real clear direction. The market's just kind of balancing in between, the overnight high and the overnight low. And you didn't really get a big enough move for the option trade to make sense. So in this case, I would go with the futures. More favorable. You got a better return. When the market's not really having a clear direction, you're still able to catch these 10, 20 point swings on the S&P and make a lot of money. Whereas with the options, they didn't really go up as much. Okay. So next thing, this is also another example of where the futures are better. Okay. Let's say we got into a short here at 45.05, which is, right around here, right around this little swing high, if you will. And we put our stop loss up here at 45.08. So we're in a short. We think the market's going to go down. And we put our stop loss up here above the high of the day. A lot of traders, futures traders, they'll find a spot to get short. And if it's near the high of the day, they'll just leave their stop a little above the high of the day. In this example, we're short 45.05. Stop loss is 45.08. That's 3 points. So the maximum we could lose is 3 points, which is $50 a point. $150 is our max loss if the price gets up here and takes us out. Okay, so our target is down at 43.55. So that means, we're risking 3 points to make a potential 50. That is, I don't even know what the risk to reward. That's more than a 10-to-1 risk to reward on this trade. This is where we're able to make a lot of money on the futures, is when you get those good swings, right? Where I find a good spot to get short. I risk only like 3 points. If I'm wrong, I'll only lose 3 points. But if I'm right and we get a big move in the futures, we could make a killing on those big swings. 50 points is $2,500. So my potential one contract, my $500 in my account could potentially turn to $2,500 if I caught that big swing lower, right? In this case, the futures, they're just kind of chopping sideways, right? Spending a lot of time doing a whole lot of nothing, but it's fine because we're short from up here and our stop loss is up here. We're not really affected by all this time being spent doing nothing, right? The time, it doesn't really bother me when I'm in a futures position, right? Because we don't have that time decay like the options does, right? So this chop doesn't really bother me in a futures trade. It's still hanging below my entry. I'm still making money on this trade. And I'm not losing money because of theta decay or the other Greeks, right? Like you would with an options trade. All right, so this is where futures are very favorable, where you get a nice trade, but the market's not really, it's taking its time to go to your target, right? So the chop doesn't really bother you in a futures trade. Time doesn't really matter. As long as you got your entry, as long as you got your stop loss, you know what you're going to lose on that trade if the price gets up to your stop. If not, you kind of just leave it and see what the market wants to do, right? And yeah, like if there's no big move, like I said, your options trade is, going to have a lot of theta decay. So with options, if you don't get a big move, your premium starts to go down and you start to lose money on your trade because it's spending time doing nothing. And that's not good for your option contract. So this choppy behavior makes you worried as an options trader, right? So this is the same exact entry. In this case, this is a SPY put with this same exact trade right here. We bought the SPY put right here, and we instantly made money on the futures, and it kind of just kept making money as time went on, even though it looked like the market was doing nothing. With the options, look at this. We bought it, it went up, it went down, it went up, it went down, it went up, it went down. So you're kind of panicking at this point with the options trade. This choppy market behavior is definitely not what you want, right? You don't want low volatility. You don't want to have time not in your favor. You don't want there to be no clear direction. So in this case, trading option is not favorable. When you're in a choppy market like this, not a good time to be trading options, right? And that's the problem that a lot of traders have. They don't know when they should be trading options. So not every day are you going to get a big clear move, all right? When you get a big clear move, yes, options can be very favorable, all right? But when you're in a choppy situation like this and you think the market's going to be have a big move, but it's really not showing and not doing that, this is where, futures are more favorable. Because if I'm in an options trade, look, I bought it here, it went up. Now I'm excited. I'm thinking, this thing is going to, this contract is going to make a lot of money. And then it just comes right back down. Now it's like, oh shit, should I close this? Is, the market going to go against me here? And then it goes back up. It's like, all right, we're back in it. Let's go. Maybe I'm buying some more. Then it comes back down. It's like, fuck, I'm down again. Should I close this out? It's a whole roller coaster when you're trading options in choppy market conditions. Trust me, I know. I've been through it. But yeah, it leads to emotional trading. But here's where the options become more favorable. All right. In this scenario, we got a big move out of the market. We start to see a clear direction in the S&P 500. And in this case, you're never going to beat, futures are never going to beat the leverage you could get percent return with options, right? So in this case, we bought an option here at $2 and it ripped up to $4.40. That's 120% gain on the futures. On the options, okay? That's 120% gain on the options. So the power of the percent returns you could get on a big move type of day in the market, options are always going to be favorable for that, okay? Without a doubt. It's not to say you can't make money on the futures and it's not a good instrument to trade. I'm just saying, like, the power of the percent gain returns you could see in options sometimes get crazy, and it could get even crazier than 120%. Okay, so yeah, that's just pretty much an example of the difference between the two, right? I'm not saying one is better than the other. I'm not saying you should only trade futures or you should only trade options. I'm just breaking down both of them to give you guys, an understanding of the difference between the two. And I love both. I trade both. I just think if you're having a hard time with finding consistent moves in the market when you're trading options, then try out futures, all right? You could also try out the micro contracts. So instead of you having to have $500 in your account, you could trade a smaller version of the S&P it's called the micro ES. So instead of typing /ES, I'm just going to type in /MES, and this is a micro version, okay? So what that means is, watch when I go long here. When I go long now on this smaller contract, every point is worth $5 instead of 50, okay? So that's a good way for, if you want to dip your toes into the futures market. You could trade these micro contracts, and you could probably fund your account with like $50 to start this, and start trading the micro contracts. And they're very liquid too, so you won't have a problem getting in and out of these. The commissions are a little high, but it's a good starting point to get your feet wet and have some skin in the futures game. And like I said, you're going to be more consistent finding good moves with futures rather than options, because not every day you get a clear big move like you need to make a lot of money with options. So futures is a better instrument to trade, in my opinion, if you want more consistent moves. Okay, so like I said, if you're new, you want to try out the micros, go ahead. These are the same exact thing. You're trading the same exact thing, the S&P 500, just these move in smaller increments. So it's $5 instead of $50. But yeah, that's the difference between futures and options. And I hope you enjoyed this video. If you liked it, please subscribe. If you got any questions, maybe something I didn't cover, put it in the comments and I'll read all the comments and have a response either in a video form or I'll just comment back. And yeah, that's it. Thank you for watching. Appreciate you. And I'll see you on the next video. Peace.